What have GPs learned about interest rate caps through all of this? And if, Brian, this is a good one because I think one of the things that when I was looking at deals for a while with all the interest rate caps, and now that I look back in hindsight, I would say 9 out of 10 of those operators didn't really fully understand interest rate caps. How do you answer this question?
I can tell you that I know I've learned a lot about interest rate caps that I knew theoretically, but didn't fully appreciate from a practical standpoint. So here's a few things that I've learned about interest rate caps. One is that when you buy your interest rate cap and interest rates increase, if you sell that property before the interest rate cap expires, the remaining period of that interest rate cap has a residual value that you can resell. And we made hundreds of thousands of dollars when we were selling properties over the last couple of years in selling interest rate cap residuals. So example, we buy an interest rate cap for 25 grand that was good for 3 years. We sell the deal in 2. We got 1 year left. We sold one of those caps for over $250,000. So it's a 10x gain with only 1/3 of the life remaining on the interest rate cap.
Wow.
So that's the good side of interest rate caps. Now, the bad side of before I get to the bad side of interest rate caps, another good side of interest rate caps is we have interest rate caps that we bought for 20 or 30 grand that are still in place on our floating rate that's paying us over $50,000 a month in payouts because interest rates have gone up. The rate cap is responsible for paying the difference between your strike rate and the actual rate. So we've got some that are paying 50 grand a month, and we literally paid like $30,000 for that rate cap. And wow. So that's another good side of a rate cap. When interest rates go up, the rate caps that you've had in place are incredibly valuable, whether you keep the property or sell the property. Now, the bad side of interest rate caps, the worst side of it is not getting one. So there's a lot of groups out there that got floating rate debt with no interest rate cap, and they're fully exposed to the market, and they're really taking it in the shorts right now in additional interest that they're paying, and it's killing a lot of these groups. Not just the fact that it's sucking all the cash flow, that's one thing, and that's going to happen. But there's some where it's sucking the cash flow and then some, and actually sucking all their reserves, and now they're completely running out of money and their back is up against a wall. So those are really problematic and may result in some foreclosures or some lost principal on behalf of those investors. So that's a downside of not getting an interest rate cap. Interest rate cap is just basically like an insurance policy, right? That is insurance against interest rates going up. Now, there's also a bad side of interest rate caps when you do get one. And that is that when it expires, you're going to have to replace it. And when you initially buy the interest rate cap, you're buying it for a period of time. And when it expires, it's over and you got to get another one. So most of the time, people are buying 3-year interest rate caps. So you might have paid $30,000 for your 3-year interest rate cap when rates were at 2% and the interest rate cap was at 4%. And the company that sold you the interest rate cap was thinking, how long shot that we're ever going to have to pay out on this. Selling you that cap for 20 grand was a economical wise decision on their behalf until interest rates shoot up to 5.3%, which is where SOFR is right now. So if you've got a 2.5% SOFR cap and SOFR's at say 5.5%, that's 3% interest on your entire notional balance, which is your loan balance. And that's a lot of money. And so now when you get to year 3 and it's time to buy a new cap, the company that's going to be willing to sell you that new cap isn't going to sell it to you for 30 grand. They're going to look at, okay, if we've got to pay you $50,000 a month for the next, let's say 2 years, then maybe $30,000 a month in year 3, because that's where we think interest rates are going to be, that cap is going to be really expensive. And that's what's hurting a lot of deals right now, ours included, is that the lenders are going to force you to stock away capital for those rate cap replacements. and that's getting expensive. I'll give you an example of one of our properties. When we first bought it, the interest rate cap reserve was $500 a month. We just got a letter now that they're increasing it to $189,000 a month.
Wow.
That's like a 10,000x or something increase in the interest rate cap reserve payment. And that compromises your cash flow for sure. There's a downside. Ultimately, after the first 3 years of whatever protection you have, you're almost fully exposed to interest rate movement on a go-forward basis, because you're going to have to buy a cap that's realistic to current rates, and you're going to end up paying for it. That's the downside.